studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that Sunky died.
In the previous section, we learned the basic 50% rule. Now let's look at the practical guidance that tax preparers use when deciding whether a meal or entertainment expense is actually subject to that rule. A good starting point is to assume that the 50% rule applies to most business meals and entertainment expenses. Common examples include client lunches, business dinners, coffee meetings, meals during business discussions, business receptions, and even takeout purchase for a business meeting. As long as there is a genuine business purpose, these expenses are generally subject to the 50% limitation. However, not every meal follows the standard rule. The Income Tax Act and CRA provide several exceptions where the 50% limitation may not apply. Examples include certain staff social events, meals that are included as part of a conference registration fee, meals provided at remote work locations or construction camps, and meals that are purchased for resale by restaurants and similar businesses. Rather than trying to memorize every exception, professional tax preparers follow a simple decision-making process. First, ask whether the expense has a legitimate business purpose. If the answer is no, the expense is generally not deductible. If the answer is yes, the next question is whether a specific CRA exception applies. If no exception applies, the standard 50% rule is usually the correct treatment. This approach makes it much easier to review expenses consistently without memorizing dozens of individual situations. As a general rule, don't start by looking for exceptions. Start by assuming the 50% rule applies, and only change that treatment when the Income Tax Act or CRA guidance specifically provides an exception. Using this simple decision process will help you classify meals and entertainment expenses correctly and avoid many of the common mistakes made by new tax preparers. Good documentation is one of the most important parts of claiming meals and entertainment expenses. Even if an expense is legitimate, the CRA may deny the deduction if the corporation cannot support it with proper records. At a minimum, you should keep the original receipt for every meal and entertainment expense. The receipt should show the date, the restaurant or vendor's name, the amount paid, and, whenever possible, proof of payment. But keeping the receipt alone is often not enough. It's also important to document the business purpose of the meeting. Ask yourself why the meal took place, who attended, and what business was discussed. Recording this information at the time of the meeting is much easier than trying to remember the details months later. A good practice is to write a short note on the receipt or keep an electronic record that identifies the client or business contact, the names of everyone who attended, the purpose of the meeting, and the date. These small details can make a significant difference if the CRA ever reviews the expense. Think about it from the CRA's perspective. When an auditor reviews a meals and entertainment deduction, they are looking for evidence that the expense was genuinely incurred to earn business income. Complete and organized records make that determination much easier. On the other hand, poor documentation creates unnecessary risk. Common problems include missing receipts, failing to record the business purpose, claiming personal meals as business expenses, not identifying who attended the meeting, or keeping only a credit card slip instead of the detailed restaurant receipt. Remember that a credit card statement simply proves that a payment was made. It does not show what was purchased or whether the expense was related to business. As a tax preparer, it's a good habit to review the supporting documentation before claiming the deduction. If the records clearly explain the who, what, when, where, and why of the business meal, You'll have much stronger support for the expense should the CRA ever ask questions. Good documentation doesn't just help during an audit, it also makes preparing accurate tax returns much easier and gives both you and your client greater confidence in the deductions being claimed. As a tax preparer, reviewing meals and entertainment expenses is about much more than simply applying the 50% rule. It's about making sure each expense is properly supported, correctly classified, and treated according to the Income Tax Act. A good review starts with the meals and entertainment expense account in the general ledger. Go through each transaction and identify the expenses that relate to business meals or entertainment. For every expense, ask yourself a few simple questions. First, was the expense incurred for a genuine business purpose? If the answer is no, the expense is generally not deductible. If it was business related, the next question is whether the supporting documentation is complete. You should be able to identify who attended the meeting, what business was discussed, when and where it took place, and have the original receipt to support the expense. Next, determine whether one of the CRA's special exceptions applies. If an exception exists, the expense may receive different tax treatment. If no exception applies, the standard 50% rule is usually the correct approach. Finally, confirm that the Schedule 1 adjustment has been calculated correctly, either by the tax software or through your own review. As you examine the expense account, watch for common warning signs: family dinners, weekend restaurant charges, missing client names, luxury entertainment, alcohol purchases without a documented business purpose, or duplicate receipts should all prompt additional questions before the expense is claimed. These situations don't automatically mean the deduction should be denied, but they do require closer review to ensure the expense is reasonable and properly supported. A simple 4-question checklist can help you review every meals and entertainment expense with confidence. Is it business related? Is the documentation complete? Does a CRA exception apply? If not, apply the 50% rule. Following this consistent review process will help you classify expenses correctly, reduce errors, and prepare tax returns that are well supported and compliant with CRA requirements.